It's Jeremy Stretch, is the head of foreign exchange strategy at Canadian Imperial Bank of Commerce, and joins us now. Let's take this in a logical progression and start with the Aussie. We've got the rate decision tonight. Presumably, though, the market's pretty much priced in all we're going to get from the RBA.
Well, that's true. We've had plenty of opportunity to price in a rate cut. Clearly, the move has been well signalled by the RBA, and we saw that backed up, or the one impediment to that, in terms of a very weak set of inflation reports over the course of the last week or so. So in that context, we should be priced in. But I think the question is, it's not just what happens tonight, but it's also what happens subsequently. Some people are betting that we may well get 50 basis points tonight. I think that's unlikely, but I think it's highly probable that we'll get another 25 basis points to come at the beginning of June. And so backing up the sort of process that we saw in November and December last year of successive rate cuts, and just reducing the yield advantage of the Aussie.
How much lower does it go?
Well, I think Aussie dollar continues, or will continue to reverse lower. We've seen obviously a move up over the course of the last couple of days, but I wouldn't be surprised as we go back into the middle of the year and into the second half of the year, we're getting back towards parity. But I think it's interesting looking at the Aussie against some of the crosses, and certainly Aussie CAD is a cross that we've been looking at for a considerable period because of the differential positions in terms of monetary policy.
ECB Thursday, any hints from Draghi that he's going to cut rates? Again, inflation abating.
Inflation is abating, but I think Mr. Draghi clearly wants to put the onus, or continue to keep the onus, on the governments, and then trying to enact austerity measures and to drive on structural reforms. So I don't think necessarily he'll be hinting too much in terms of easier policy, and of course, no doubt the press conference will be made up of lots of questioning about further LTROs, etc. But I think obviously the elephant in the room as far as the ECB is concerned is those political dynamics which are really playing out over the course of the next few sessions, particularly as we get to the French presidential election on Sunday and the Greek election also.
Precisely. Which of those two do you think is likely to cause the greater surprise? Greece has been off the radar screen. The polls are making it clear that Hollande's going to win. If we get a fragmented vote in Athens, do you think the market will refocus, and could that be a catalyst to drive euro lower, like below the 130 level?
Well, I think it is surprising that Greece has effectively just dropped off the market's radar screen. Now, you could argue that, of course, we've seen bailouts, so in essence, it should be a done deal. But, of course, the election itself could well find some parties in government, or at least in the coalition, who weren't party to the bailout mandates. And so those austerity measures that we've assumed would be enacted may well be under some doubt or in some question. And so I think that does raise the risk of another negative to overlay the issue relating to Mr. Hollande.
The problem with all of this is that you traded 134, 130, there was a 130, 134, 135 forever now, it seems. What is it going to take to drag us to the downside of that? Because the euro is like the magic carpet. You don't know how it stays up, but it does.
That's true, but in essence, I think that probably comes back to the perception that we're all fixated with euro-dollar. I think we perhaps need to look at some of the other crosses, because clearly in some of those we're seeing pressure on the euro. So we've seen euro-sterling moving sharply lower over the last few sessions. That's obviously continuing to look interesting. Euro-Canada, again, another cross that I think will continue to head lower. So I think it may well be interesting or worthwhile looking beyond just the simple euro-dollar and looking at some of the other crosses. Euro-yen, I think, is another currency which looks vulnerable to further downside moves.
Okay. Let's talk about the CAD. You've mentioned it, I think, 5 times so far. The market's getting quite excited about potential for Carney doing something, hiking rates. The rest of the world's not in hiking mode at the moment. You're not convinced?
Well, I think the markets clearly want to see something from the Bank of Canada. The rate statement clearly changed the game as far as the market was concerned. We've seen investors adding to long positions. I think there is some way to run in that. So I think the Canadian dollar will continue to be well supported over the course of the next 3 to 6 months. The question is, of course, whether the data will be strong enough to back up that degree of rate tightening. So I think it may well be the case that the Canadian dollar has a good short-term momentum, but it may well be the case that as we go into the third and fourth quarter, that some of that momentum will dissipate because markets will realise that the bank isn't going to be able to tighten in the way that it's perhaps been pricing in.
There is this argument that says that if they hike, it'll be a problem for Canada's economy because of the debt levels, and that actually if they hike, you should sell.
Well, I don't. In the first instance, I don't think they will hike. So I think that's the thing. So whilst the markets are pricing that in, or at least been discussing it, I don't think necessarily that will come to fruition. Clearly, there are a number of issues relating to the underlying picture if they were to hike, and how that would play out, particularly in terms of the relationship between the Canadian dollar and in terms of manufactured exports into the US. And clearly, you can argue that the Canadian fiscal position looks comparatively good, at least at the top line level. Perhaps when you drill down, it doesn't look quite so encouraging in terms of the federal debt. But overall, I think that Canada could withstand a tightening in monetary policy. But as I say, I'm not convinced that it will be coming through in the way that the market is anticipating.
Let's just wrap up with the pound. Despite negative data coming through, cable continues to do very well. You're continuing to see the British pound doing very well against the euro. Logic would dictate that you're starting to reach the upper ranges. We're at 163 against the dollar at the moment. But on the other hand, if you assume that, say, the euro crisis gets much worse and you're looking for a safety trade, it's one of the few that's left out there. How do I rationalise those two positions?
Well, you're absolutely right. It is a bit of a dichotomy. So in terms of cable, so sterling against the dollar, I think once you get north of 163, I become a little nervous about continuing to trade it higher. So I would certainly be looking to maybe fade some rallies into 163, 163 and a half. But I think having said that, I think euro sterling will continue to go lower, probably back towards the 80.5 threshold. And that's ultimately arguing that euro-dollar will eventually move back lower as well. So I think sterling has some virtue. I think it still has some virtue within Europe as a safety trade versus the eurozone. But I think it will be vulnerable to a correction lower against the US dollar.
Do you think the Bank of England will look at that and say, we're worried about our export position? One of the things that it's been a sort of tacit story. It hasn't been an overt, we're going to lower the rate of sterling, but it's effectively achieved that. Do you think they'll look at this and say, there's another argument for doing a bit more QE?
Well, we've seen sterling trade-weighted, a 32-month high this morning, so clearly sterling is rallying on a trade-weighted basis. Almost as long as I've been in the market, we've been talking about a rebalancing of the UK economy away from financial services and increasing manufactured exports. The evidence in terms of a rebalancing or an improvement on the trade side has been very sporadic, and that's probably at best in the first quarter of this year. So you could argue that, of course, our external markets are under pressure. So the value of the pound, yes, is important, but it's probably the actual degree of momentum in those underlying markets that's probably more significant than the actual value of sterling itself.
Jeremy, nice to see you as ever. Thank you very much indeed. Jeremy Stretch joining us from the Canadian Imperial Bank of Commerce.